what's going on? Welcome back to my real estate bootcamp level 2. Last week we made a video talking about some of the basic terms and principles and concept of real estate. We touched on what kind of houses you're going to see out there, what kind of properties you're going to encounter in the marketplace. We talked about mortgages, we talked about equity, we talked about renting out your unit and what a cash flow is. So if you want a quick refresher, I'm going to link that video below, so go check it out if you missed that video. But this week I want to dive a little bit more into mortgages. So the 4 things that you're going to run into when it comes to mortgages, and that's your down payment, getting a pre-approval, what a fixed versus variable interest rate, and of course what actually drives the interest rate. So these are things that you're going to run into quite frequently when it comes to mortgages. And of course I am not a mortgage specialist, so I just want to put that disclaimer out there. If you do have any specific questions where you're thinking about buying a home, make sure you talk to your mortgage broker about your situation. This video is mostly meant to educate you guys on the basics, okay? So let's get started. Down payment. So the reason why it's called a down payment is because it means that you got to pay this money up front. So say for example you're buying a $500,000 place. Let's just quickly put that here, $500,000 place. And generally speaking, most bank will require you to put down 20%. So take that times 20%, it gives you 100,000. So essentially this just means that for the bank to put up the other 400,000 to buy this home, you're gonna have at least $100,000 saved up. So this is your down payment. Let's say you don't have 20% of the purchase price as a down payment. It is still possible to get a mortgage and still purchase this house with 10% down or even 5% down. But in this case, the bank is going to require you to get something called a mortgage insurance. And this just means that in case you default on your loans, the insurance company is going to come in and rescue you and make sure the bank gets their money back. In Canada, we have our CMHC, which is the Canada Mortgage and Housing Corporation, and they are going to be the guys that's going to issue this insurance to the lender. Now, this is not free. Obviously, they are going to charge your lender a premium to insure their money, and this premium will be passed on to you as the person getting the mortgage. Now, the percentage of this premium they're going to charge is based on the loan amount. So check out this chart here. It's directly from the CMHC website, and it basically tells you the more you borrow, the higher your premium is going to be. Now let's say for example, we're going to choose to put out 5% and then take out the other 95% as a loan from the bank. So in the case, the same $500,000 house, the same $500,000 house, at 95%, this is how much we're going to take away from the bank. That is going to be $475,000. So this $475,000 is what the bank is going to put up, and you're only having to put down the 5%, which is the other $25,000. Now in this case, looking at the chart, at the 95%, you're going to be paying a 4% premium to cover the insurance in case you default. So at 4% of $475,000, it's $19,000. So now you have the option to pay this $19,000 as a lump sum, or you can break it up and combine it into your monthly mortgage payment. So that's totally up to you. But generally speaking, it is still cheaper to get this insurance than it is to go without being insured and getting charged a higher interest rate. All right, guys, so let's talk about getting pre-approvals. So essentially, this is a very important step in your home buying process. And the reason for that is before you can go out and purchase a home, like we talked about earlier, unless you're planning to buy this home with all cash, you're gonna need help from the bank. Now, this step just says, I'm gonna go to the bank and say, how much are you willing to lend me for me to purchase a home? And for that to happen, the bank's gonna have to be like, well, let me know how much you're making right now. What are some of the assets and debts you're already carrying? And then of course, we're gonna do a credit check to see what kind of borrower you are, essentially assessing the ability for you to repay them if they do give you this loan. Once the bank has all the information, the bank will essentially spit out a number that says this is the amount we're gonna loan you to purchase a home, making sure that they can still get their money back by how much you already make. So once you actually have this information, it actually makes it easier for you to find the home that you can afford. It narrows your search criteria, so it's actually a very good thing to have this kind of in your back pocket. The other really important thing about being pre-approved is that you hear people say that in today's super hot housing market, unless you have a subject-free offer, it is very hard to compete to win a bid on a home. What essentially that people are saying is that one of the main subject tos in a buying contract is that people need to subject themselves to proper financing. So before they can actually execute that contract, they need to say, I have to get the proper money to be able to purchase your home before we can go through with it. So having pre-approval just means that you are confident that the bank will lend you this money. So when you when you submit your offer to buy a home, you can say, I don't need financing. I already know the bank's going to supply me with this money, so we're good to go on that front. And that makes it much more likely for you to win a offer on your dream home. So let's talk about fixed rate versus variable interest rate when it comes to getting a mortgage. When you decide which one's the right one for you, according to Rate Hub Canada, 66% of all mortgages are actually fixed versus 29% is variable. And the reason why so many people like the fixed interest rates is because I think they like the guarantee. With the variable, even though it's got a smaller interest rate, it varies day to day because it changes the market. So for that unpredictability, the bank offers a smaller interest rate. Now with the fixed interest rate, in the term, typically 5 years, your rate will stay the exact same. So for that purpose, I think fixed is a little bit more attractive because you don't want your mortgage payment to jump from, say, $1,000 a month to $1,500 a month the next year. So if you're someone who likes to gamble, and maybe I shouldn't say the word gamble, maybe let's say you want to take your chances with the variable rate because right now it is lower than the fixed. So you might want to understand the factors that actually drive interest rates, so you can kind of at least have a bit educated guess on whether it's going up or going down. If you think the interest rate is going to go up in the future, then it's probably smarter to lock in to a fixed rate. But if you do think, judging by the factor we're going to talk about right here, that the interest rate is going to stay low or even go lower in the future, then chances are you're going to be better off paying less money by going with the variable rate. So let's just quickly touch on the 5 factors that typically drive the interest rate. And that's inflation, economic growth, monetary policy, the bond market, and of course the housing market condition. Let's go through these one by one, and I'll tell you a little bit about each one of these, and so you can kind of assess for yourself. So let's talk about inflation. Typically, a lender is going to keep their interest rate high enough so that it can overcome the inflation and then still have enough return for them to make money. So for example, say if the mortgage interest rate right now is 5%, let's just write 5% here, and the inflation is 2%. So really what the bank is making in return is actually 3% because 2% of that money is being eaten up by inflation. Now, for example, say if inflation actually rises, let's say the inflation is now 3%. Now, for the bank to still keep their 3% return, now they're gonna have to jack up the interest rate on mortgages to make sure they still get their 3%. So that will make it 6%. So you see, as inflation goes up, interest rate is gonna have to go up to make sure the bank still makes their 3%. Number 2, economic growth. So typically when people are starting to make more money and as the economy gets better, people tend to spend more money as well. And as people are ready to spend more money, one of the main things that people consider doing is buying a home. As that thought kind of prolongs into getting a mortgage and buying that house, people are going to demand borrowing money from the bank. At this point, the bank has only so much money to lend out. So the bank, how do they stop people from all coming in to get money is that they're going to rise the interest rate a little bit to make sure only certain people still come in and get money, so they have enough to spread it around. Now, the opposite is also true. If the economy is slow and no one's coming to borrow money and the bank is sitting on a ton of cash, they're going to drop the interest rate to make sure that borrowing money from the bank is still attractive enough that people are willing to go there and buy a home. Third, monetary policies. We have what we call a Federal Reserve, and their main goal is to actually control the supply of money in the marketplace. So they have the power to adjust money up or down the supply of it. So think of it as supply and demand. More money, meaning easier money to borrow, more money to go around. The bank's going to drop their interest rate to make sure money gets around. And then, of course, the opposite being true. If there's not enough money in the marketplace, everyone's hoarding their money, no one's really spending it, then the bank will have less money to spend as well. In that case, they're going to jack up the interest rate to make sure not everyone's running to the bank and cleaning their cash out. So number 4, the bond market. This is a little bit more complicated. Essentially, banks and some investment firms will issue something called a mortgage-backed security, or MBS. And essentially, this is an investment vehicle for people to buy, and it's based on people paying back their mortgages, and off the interest rate that they're paying, a bank will kind of take some of that and give to the investors. So for that to stay competitive to other investment vehicles in the marketplace, like a government bond, is typically they have to make the interest rate just high enough so that they themselves get some money and they have enough money to share to their shareholders, but also high enough because this is not 100%, it's not guaranteed, right? People default on their mortgages all the time. So if people default, you don't get your money. Unlike the unlike the government bond, which is almost 100%, you get your money back. So for that to happen, they have to make sure the MBS or the mortgage-backed securities gives a higher return. So for that higher return to happen, they need to charge you enough of interest rate to make sure they can still afford that spread. So a lot of times what you're going to see in the marketplace is that the mortgage interest rate actually follows the 10-year treasury bond yield. So as the treasury bond yield goes up, the mortgage rate is going to go up as well. Number 5, and lastly, the housing market conditions. So at the end of the day, if there's not enough houses on the market, whether there's not enough new houses being built or no one wants to sell their houses because it's COVID, nobody wants to list their house, that means there's less purchasing going on, meaning that there's not enough mortgages being taken on the banks. The bank will kind of drop their interest rate to motivate people to come borrow more money. One of the other things to consider is that more and more people are choosing to rent instead of buy. So as people rent, meaning that they're not going to the bank to take out a mortgage, so the bank also takes that into consideration and again, dropping their mortgage interest rate to make sure that is still attractive, that people want to buy homes and borrow money as an option. I hope this information is helpful. Again, I am not a mortgage broker, so if you have any questions, I will highly recommend you go speak to a mortgage specialist, especially if you're thinking about buying a home. This is going to be a very important step in the buying process. So otherwise, if you do enjoy this content for the purpose of education, smash that like button, drop a comment, subscribe to my channel, and I'll see you guys in the next video.